So, plainly and simply, not a great result for Uber. What about the rest of the ride-hailing industry? We're going to talk about that with Michael Cusumano. He's the Sloan Management Review Distinguished Professor of Management at MIT and the co-author of The Business of Platforms, Strategy in the Age of Digital Competition, Innovation, and Power. Michael, thanks very much for joining us. I appreciate it.
Okay, thank you for having me.
Now, clearly, the street has concerns about Uber and its ability to be profitable anytime in the near future. Give us the highlights as you see it from this report.
Well, this report is a very short term. The $5 billion loss was due to stock compensation associated with the IPO. So that's not their ongoing run rate. But for this year, they should earn, they'll have negative earnings, but they should generate about $12 billion in revenue and lose maybe $3 billion, maybe a little bit more than that. So in general, ride sharing is not a good business. There's no magic associated with digital platforms that will make Uber or Lyft really profitable businesses. And this is the mistake, I think, of a lot of investors. You can call for the ride on a digital device, but they're not selling a digital service. They're selling a physical service. So they need millions of drivers and they need 100 million riders just to generate this revenue. And the economics really don't work. And I can explain more about that, but it doesn't work. It never did. It probably never will.
And the streets are more crowded as well. But let's look at the health of both Uber and Lyft. Lyft's COO left after just a year and a half on the job, and Uber just let 400 employees go. It really doesn't look like it's a shining time for either of these entities.
Well, the bigger problem with Uber in the last couple of years has been loss of drivers, driver churn. So we have some data now, at least prior to the IPO, they were losing about 12.5% of their drivers per month. So the last couple of years, they had about 3 million drivers. So you do the math, they're losing close to 400,000 drivers per month. And they have to replace. So every 8 months, they have to replace 3 million drivers. And that's what it's been like in the past. It also has cost them $650 to replace each driver. Wow. So you total that up. Last year, or the year before, they spent about $3 billion annually just on advertising for drivers and hiring drivers. And that's not including the costs of paying the drivers compensation for the percentage of rides that they drive. Yeah. So it's very expensive for Uber to keep all these drivers on the flywheel, so to speak.
Michael, someone asked me earlier today, and I just didn't have the answer. They have drivers and they have some marketing people. What kind of other overhead expenses do they have?
Well, they have quite a lot of R&D. First, they've been investing very heavily in driverless car technology because they're trying to eliminate drivers. Their biggest expense is the 4 million drivers they have. So if they could eliminate that, they think they can bring down their costs. So they invest heavily in that. And their computer systems are rather extensive, and their servers and server systems. Remember, one of the other bigger mistakes I think that Uber has made is they try to be everywhere. And actually, some markets, they actually make money, but in most markets, they don't make money. But still, they have to have local offices, recruiting for drivers. They have to have computer services. So all that adds up.
Now, should these apps have gone public sooner? What kind of strategies are in place, if there are any, to make them profitable down the road?
Well, you know, ever since the dot-com boom in the 1990s, and then, of course, there was a bust in 2000. But we've seen a lot of companies go public that are not profitable. So being profitable is not a requirement of going public. Right. And so this is really like I'd call it a game of musical chairs with investors. And the early investors that came in, they're going to get out after they go public. They want the company to go public because then the shares become liquid and they can sell them. And employees want that too. But it's round after round of investors, and now the public is buying shares. And when the music stops, somebody's going to be left holding a lot of debt.
Yeah. Michael, quickly, what about more regulation in the future? How will that affect these companies?
So there could be good and bad things. So one argument is that a lot of these platforms have been started as businesses because they were able to skirt regulations, like they don't have to pay insurance or taxis that normal taxi companies do. But those are being changed at the city level. And so cities are clamping down, and some countries have clamped down. But the other issue is their drivers are temporary contract workers, and that's why they lose so many. So many drivers just drive for Uber for a few months and then they drop off. If they were regular employees or Uber was forced to pay them more, that would be more expenses. But actually the good side of that, if regulation does force Uber and Lyft to hire drivers as regular employees, probably they will not quit so frequently. So they won't have those, those multi-billion-dollar expenses of hiring drivers.
Great. Michael Cusumano, we appreciate it. Great insight into something that's drawing a lot of attention on Wall Street. Thank you.